Silver called, levels held, price delivered. But that was just the beginning. What happened overnight changes the entire framework, not just for silver, but for every critical mineral on the planet. A government-backed price floor, a COMEX with 285 million ounces of paper against 92 million ounces of real metal, a mining sector sitting at its most undervalued point in 6 decades, and a geopolitical situation that could erupt within weeks. If you think this is just another metals rally, you are not paying attention. Stay with this. Every number here is verifiable. Every level is mapped. This is the full picture, technical, fundamental, and geopolitical. Let's get into it. Silver did exactly what the previous analysis said it would do. The 72.6 to 70 support zone held. Price respected that February 6th candle as the anchor. The swing failure pattern played out, and silver moved from that support zone all the way to 75.5. This is not luck. This is structure. Right now, upside objectives sit at 77 and then 78.2 if buying pressure continues. Immediate downside support is 74.8 to 73.9. Body closures below that range are a warning. Wicks touching it are acceptable. That is just liquidity being tested. But if bodies start closing below 73.9, the bounce is weakening. The February 6th candle remains the anchor for this entire setup. Price has to hold its proximity. That is the technical framework. Everything else happening right now silver is called, what makes levels this held, different from price any previous delivered. Silver rally. But that was just overnight. The United States what happened revealed overnight changes the entire minerals framework, price, not just for silver, but is for every actively critical pitching mineral it to on the allies. planet. A government is to reduce dependence on China for resources 285 million ounces of paper against multiple agencies built this mechanism. Ounces of officials confirmed conversations. A mining sector sitting at its most undervalued point in 6 Silver decades. Surged over $3. And a geopolitical situation that could erupt within weeks. A government-backed price floor. If you think this is just another metals rally, you are not paying attention. Stay with this. Every number here is verifiable. Every level is mapped. This is the full picture. Technical, fundamental, when governments guarantee minimum prices for strategic. Silver did exactly what the previous analysis said it would do. This is no longer 6 to 70 support zone held. Motion. Price respected that directly inside candle as the anchor. As a critical industrial the swing failure pattern played out. The COMEX situation is not a talking point. It is a mathematical problem that gets worse every single day. Registered silver currently sits at 92.2 million ounces. March open interest is 285.3 million ounces. That is 193 million more paper ounces than deliverable metal. March open interest only dropped 7.6 million ounces in the latest reporting period. For the market to reach normal delivery levels, open interest needs to fall roughly 30 million ounces per day. That is not happening. The roll pace is far too slow. The carry-adjusted contango sits at just 4.9, meaning the market is paying almost nothing to push demand out to May. When there is no incentive to roll, pressure builds on the March contract daily. 8 days remain until March settlement begins. The numbers are public. Anyone with access to CME data can verify this independently. The tightening is accelerating, not resolving. Hecla Mining just reported results that show exactly what happens when silver prices move toward reality. Revenue exceeded $1.4 billion, up 53% from the prior year. Net income reached $321 million, a 9-fold increase year over year. Silver production hit 17 million ounces, at the high end of guidance. Total debt was cut by 50%. Net debt dropped to just 34 million. Every operation was free cash flow positive. This is a company that was surviving under suppressed prices now generating record profitability as prices move toward fundamental value. This is not an isolated result. This is what the entire sector looks like when the paper market loses control of physical pricing. Mining companies leveraged to silver prices move violently when the fundamental shift arrives, and Hecla's numbers are the early proof. Ray Dalio has been clear. Escalating trade tensions, growing fiscal deficits, and declining confidence in U.S. debt create conditions where hard assets shift from optional to essential. When someone managing institutional capital at that scale repositions toward gold and commodities, it is not opinion. It is a signal about where large institutional flows are heading. His framework on debt cycles and currency debasement has been consistent for years. The phase we are entering, where governments prioritize strategic resource security over free market economics, fits his model exactly. Capital that has been concentrated in equities and tech begins rotating toward assets that hold value independent of government solvency. Silver, sitting at the intersection of monetary and industrial demand, benefits from both sides of that rotation simultaneously. The Iran situation deserves serious attention from anyone tracking industrial commodities. Reports indicate the U.S. is building military presence across the Middle East, carriers, warships, fighter jets, weapons deployments. Officials have warned that if diplomacy collapses, any military action would not be a limited strike, but a large-scale, weeks-long conflict. 20% of global oil flows through the Strait of Hormuz. A prolonged disruption there does not just move oil prices. It fractures global manufacturing supply chains that depend on Middle Eastern energy inputs. Silver is in its sixth consecutive year of structural deficit. Industrial demand already exceeds supply. Any shock to global manufacturing logistics tightens that deficit further and accelerates the supply crisis that is already developing independent of geopolitics. Mining stocks represent 1% of global equities today. From 1900 to 1965, the historical average was 8%. At the 1955 to 1965 peak, it touched 10%. For mining to simply return to its long-term historical average, it would need to rise 8 times relative to global equities. To reach historical peak 10 times. This is maximum pessimism in a sector that governments around the world are now labeling as strategically critical. Reshoring industry, rebuilding supply chains, securing energy independence, none of that happens without metals. Capital allocation in this environment stops chasing maximum margins and starts guaranteeing supply regardless of cost. Mining moves from cyclical to strategic. The historic underweight in mining shares exists precisely at the moment the fundamental case for the sector is the strongest it has been in decades. The FOMC minutes release at 2 p.m. today is the immediate catalyst to watch. This is a high-impact event. Volatility around that window is expected in both directions. If the minutes signal a more hawkish stance than markets anticipated, pressure on risk assets, including metals, could develop quickly. If the minutes confirm a dovish lean or pause in rate policy, the current upside momentum in silver has room to accelerate towards 77 and beyond. This is not a moment for prediction. It is a moment for preparation. Have both scenarios mapped before the release. Know your levels. Know what price behavior confirms continuation and what behavior signals a breakdown. The tape will tell you which scenario is playing out. Read it. Do not anticipate it. React to confirmed structure, not to what you hope happens. Everything on the table right now is pointing in the same direction. Technical levels playing out as mapped, a physical market under historic strain, government policy shifting the rules for strategic commodities, institutional capital rotating toward hard assets, and geopolitical risk building in a region that controls a fifth of global oil supply. The majority will look at a silver price that has already moved and assume they missed it. The informed minority understands that price moving from 70 to 75 inside a structural deficit, a policy shift, and a COMEX imbalance of this magnitude is not the end of the move. It is confirmation that the setup was correct. Stay disciplined. Watch the levels. Let the FOMC minutes tell you where the next leg goes. The data has been laid out. The sources are public. The work is yours to do. Stay informed, stay prepared, and as always, invest with logic, not hype.